afternoon, everybody. Welcome to the hottest market in Europe, according to the organizers of this conference. So we're happy it's filling up, even though this room is not easy to find, we find. I would like to welcome two investors. To the left, we have Gaël Lelay from Foncière des Murs, a hotel REIT in France. And Gaël is the Deputy Chief Executive Officer of the hotel fund, worth around 4 billion, I think. Then Andreas Löcher, potentially known to some of you, Head of Acquisition and Sales at Union Investment, an equally large player like Foncière des Murs in the hotel sector. Then we have Ian Biglands, Managing Director for Premier Inn GmbH, in charge of development, 100% subsidiary of Whitbread PLC. And Klaus-Dieter Jandl, representing another hotel operator from Steigenberger Group. He is Executive Vice President and Chief Development Officer. My name is Olivia Kausen. I head up the German division for CBRE Hotels. And before we start with the discussion, I'd like to say a few housekeeping things. If you have any questions, you can happily, if they're urgent, you can ask them while we speak, or otherwise after the discussion is over. And I would like to just set the scene with a few slides about the German hotel investment market. The slide you see here shows how the European hotel investment market is divided between the different countries. It shows that the UK is actually the hottest market in Europe, almost 50% of the investment market. The majority of this is obviously London, which plays a major role, and the UK had an increase in hotel transaction volume of more than 100% last year. But Germany is the second biggest, as you can see, the light green piece of the cake, quite a big piece of the cake. And what is interesting here is that we have about double the size of countries like France and Spain. Historically, France used to be much bigger than Germany because of the dominance of the Paris hotel market. But this, in the last years, has changed considerably. And what's also interesting is that Spain is really catching up, even being a little bit bigger than France. So Spain is really a very sought-after market at the moment. This shows the German commercial transaction market, and it shows what share the hotel investment market has as part of the general commercial real estate market, which is dominated by offices and retail. This year in 2015, you see the retail piece is getting quite large. But what you also see is that hotels is now the third biggest asset class in the German commercial real estate market. We account now for 8% of the total commercial real estate market. Historically, this figure has always been at around 5% and gradually creeped up over the years, showing the acceptance of hotels as a mainstream asset class to invest in for a lot of investors in Germany. This shows you the dramatic increase in transaction volume in Germany. We start in the year 2007, which was the last boom, when we had a transaction volume of 2.2 billion, which we considered the absolute peak, and we'll never reach it again. Remember, the years after the crisis, we thought, God, 2 billion, so much. And what you see now is that the bar on the right, 2015, we have now reached 4.4 billion, so more than double of the last boom. And this was possible not only by an increase in single asset transactions, but also a very large increase in portfolio transactions. We've seen a lot of them last year, the Interhotels Group, the Accor portfolio, the Leonardo portfolio acquired by Pandox, and a few others. This is a chart showing you how hot the German market is, if that's an appropriate word. The growth in revenue per available room, which has been quite healthy the last few years. It doesn't go through the roof because you see the curve is not as steep, but it shows a good and healthy growth since 2009 when we had a big dip. But you see the very strong recovery in 2010, and the growth since then. This makes the German market really attractive because it's quite a stable market. It shows to you also the strong performance of the Munich market, which is the line at the top. It's quite some distance to the other markets. The Munich market is by far the healthiest market in Germany because it has very high occupancy levels and very high average rates. You see Berlin still at the low end, but gradually catching up and improving. This slide shows to you the overnight stays divided by the key cities. We've put that up to show you the dominance of the Berlin market. We have now reached around 30 million overnight stays in the market. So we are getting closer to Paris, Gaël. I think you're around 36 or something in Paris. But the growth rate in terms of overnight stays in Berlin is really quite dramatic and has always outperformed the growth in supply in the last 10 years. The second biggest market is Munich, around 14 million, followed by Hamburg, Frankfurt, Cologne, and Düsseldorf. And the German market is dominated by these cities. The investment market, around 3/5 of the market of the investors invest in these 6 cities. And we don't have a city like London, which records, I think, nearly 60 million overnight stays, so roughly double of Berlin. But if you add the overnight stays together of all these cities, you arrive at around 76 million. So it's really a very large market also, which attracts investors. This shows you the prime yield development of the hotel for hotels in relation to office markets, prime office yields. And as you see, the curve goes down not only for hotels but also for offices. For offices in Munich, the prime yield is now only 3.65%, so really, really low. And for the hotel market, we record a prime yield of roughly 5%. But having said that, there are a few transactions, especially in Munich, that are even below that figure. So that the trend is still downwards. So that's it. No, I still have one more. This is also a slide on Germany. It shows where the capital comes from in Germany. The international market, obviously the German domestic market is quite big, thanks to people the likes of Union Investment, who are very large players in our market. But 50% of the capital in Germany comes from outside of Germany. The key source last year has been the US. We've seen some large portfolio transactions like the Interhotel portfolio and others, where we had US capital coming into the country. Another portfolio is the Leonardo portfolio that we spoke about, which was bought by Pandox, which explains the Swedish source, which is not usual for the German market, that we have so much capital coming from Sweden. Then we have Gaël Lelay here representing most of the capital coming in from France, together with Accor, who's also a big player in our real estate market today. And we always have a lot of players from the UK who are also very interested in the German market. So that's it from me in terms of introduction. Apart from talking about the hotel market, I think it's also important to know that Germany accounts for around 20% of the economy in the EU, so it's a very large country economically, and we have quite healthy GDP growth, also projected going forward, around 1.5% to 2%, depending on the sources. We have a very low unemployment rate, so the fundamental data at the moment, despite the black swans and political issues, refugees and other things, the fundamental data is still good. And I'd like to hear from the panelists here, the investors to my right and left, and also Ian representing an owner and operator, and Klaus-Dieter Jandl, what their opinion is about why is Germany a hot market for them, and to introduce themselves quickly, what their portfolio is made up of and what the strategy is. So if I start with Gaël, please.
Okay, thank you, Olivia. So I'm representing Foncière des Murs, which is a French REIT, and with roughly 4.5 billion euro of real estate under asset management. And among these 4.5 billion, we have 3.5 billion in hotels and 1 billion in alternatives such as care homes or restaurants. But definitely the core part is the hotel part. And we are owned by Foncière des Régions, which is a French REIT as well. And 9% is listed, and the rest is split between 4 insurance companies. So, which is to say, we are a long-term player and with a long-term strategy. In terms of portfolio, 3.5 billion split with, we are the first owner of Accor so far, with roughly 2 billion euro, and first owner of BNB, and with roughly 850 million euro allocation. And we have also partnership with Louvre Hotel and developing new partnership with Motel One, NH, Meininger, and so on. And clearly, well, in terms of geographical allocation, we're at 75% France today, 25% rest of Europe, split between Belgium, Netherlands, Germany, and Portugal. And definitely, we'll speak about the strategy, but we have a strategy of diversification of countries. As you mentioned, cycles are quite different, and we see a strong interest to be invested in Germany, because as you mentioned, you have quite a stable growth and relatively secured investment, and we feel that today we have roughly 300 hotels in France, and this is Germany's second national continental market, and so why not having one day 300 hotels also in Germany? It could fit our portfolio. Today we're at 70. So we still have growth.
So more than 200 to buy.
Yeah, and but clearly, and in terms of hot market, we strongly believe that German market is not completely mature in terms of hotel business, especially in the budget segment, and this is where we have strongly invested. And we started with BNB 3 or 4 years ago by acquiring existing BNB, and now we have 50 BNBs with you, and definitely this is part of our strategy to not only develop the budget. We started with the budget, but now we go to also upscale and mid-scale hotels in Germany.
Okay. Thank you, Gaël, for the explanation. If I may pass on to Andreas to tell us a little bit about Union Investment and what you consider hot about your home market here in Germany.
Okay. Let's get started. Well, we at Union Investment, we have been investing into hotel real estate more than 40 years and have a great expertise in the industry and also, therefore an entire exposure of around 50 hotels in all of our funds, so which accounts around 2.7 billion euros only in hotel assets, which is around 10% of the entire exposure of real estate at Union Investment. We basically have two different form of funds which we're investing in. It's on one side the retail funds, which are distributed through the so-called German Volksbank, and on the other side we also have various institutional funds. So we at the hotel team are responsible for the acquisition for both of these lines, retail and institutional, and therefore you can imagine our target is quite diverse to invest for the funds. We have 7 or 8 funds who may have an interest in hotel real estate, so therefore we may source deals from around 25 million euros for institutional funds, going up to levels like 150, 200 million for the big open-ended funds, the retail funds. So far our exposure is around 2/3 located in Germany. Of course, one of the reasons is that we're coming, that's our home market. We've been active here for many years. But of course, internationally, we have been growing as well. We are well spread all over Europe, in the UK, France, Austria, Poland, Spain. So there are various countries which we are active in, and we recently have been entering the US with our first investment, actually on the lease agreement basis, which I would regard quite revolutionary, but I think we've somehow managed to really find the right formula in doing lease agreements also in the US, and there'll be more to come. Not having mentioned so far is our hotel fund, Hotel Number 1, which is dedicated to budget and economy hotels only. Quite a success, a real outperforming fund within Union Investment with institutional investors' background. Then you were already questioning about the hotness of the market. Then, well, I could talk a lot about that, of course. You gave a lot of the arguments already, but I think the core argument here is that that it has strong fundamentals in Germany, strong economic fundamentals. You can see it on the RevPAR growth, which has been steadily going up, which is somehow reflecting also the economic situation in the country. So therefore we of course like to go international, but still are very happy with continuing our investment strategy within Germany. What else? There are many factors why Germany is so attractive. Think about the decentralized situation of Germany. You have a Munich, you have a Hamburg and Berlin and Cologne. There's a lot of domestic travel, you know, a Hamburg businessman going to Munich, staying overnight or the other way around, or also the city trips, Berlin, Hamburg, Munich, where people are going for the weekends on the domestic market. On one side, being a very strong demand driver on one side, and then now in addition, the international markets, international demand increasing steadily over the years. Not really just jumping up, but have been increasing steadily over the years from Asia, but also from other European countries and the US.
So you mentioned your hotel fund number 1. Does that imply there'll be number 2, 3, 4 as well?
Well, we're in the middle of sourcing, well, quite progressed sourcing this fund, and we'd like to bring it to a very successful end. But I'm sure that at the right point of time we'll launch another one, but at a given time. We'll see.
Okay. Okay. Then I pass on to Mr. Jandl from the Steigenberger Group.
Yes, ladies and gentlemen, good afternoon. First, I would like to introduce myself. My name is Klaus Jandl, as you heard before. I'm now working since more than 40 years in the industry, and out of these 40 years, more than 35 years for Steigenberger, so I'm quite a Steigenberger baby. And I'm running the development department. Well, actually, I built it up 6 years ago. As before that, you could not see any development with Steigenberger. 6 years ago, we started again to develop the company. And I run a team of very enthusiastic, young and nice colleagues. Steigenberger itself, it's an 85 years old company. It was founded in Germany. It was existing in Germany, with most of the hotels still being in Germany. We are based in Frankfurt. At the moment, we operate 93 hotels in our 3 different brands, Steigenberger, Intercity, and the new opening in Amsterdam with Jazz as the new brand. We have 25 further hotels in our pipeline, and as I explained earlier on, pipeline for us means that the hotel is signed, financing is cleared, and construction permit is existing. So it's a real proper pipeline. So it's another 25 hotels which we expect to be opened within the next 2.5 years. The company has a turnover of about 600 million euro per year. We're very happy to have no bank liabilities at all, not a single cent. We are very cash flow rich. All our development and all our things we do out of our cash flow. If you look in our balance sheet, you will be quite astonished. You see 600 million turnover and almost no results, but this is how we operate. We reinvest the money we earn into the company immediately. So that's why we are very strong and very market strong, which allows us for our business model to sign lease contracts. In Germany mainly, the portfolio at the moment consists of 60% lease-based contracts and another 40% of fee-based contracts, which mainly are management contracts, and a few of them are franchise contracts.
May I ask, the management contracts all outside of Germany?
No. We have management contracts with Steigenberger and Intercity brands as well in Germany. And we just signed 15 months ago, 1.5 years ago, a management contract for Cologne. And so there is still a market for management contracts in Germany as well, especially if investors come from out of Germany. Of course, with Union Invest and our other friends in Germany, it's very hard to discuss about management contracts. They don't really like it. I don't understand why. The upside is much better for them, but in the German market, we like the upside as well. So
you have the upside in the lease agreement, no?
Yeah, that's why we prefer. That's what I said. That's why in Germany actually we prefer to have a lease agreement. So this is roughly all about Steigenberger, and I think we have more questions later on.
Ian, can you say a few words about Premier and your relatively new entrant to our market?
Yeah, we're the hello, good afternoon. We're the new boys here. And we've just entered the market. We actually just opened our first hotel in Frankfurt 2 weeks ago. So we've actually got a hotel in operation in Germany. But we come out of the UK. We have 730 properties in the UK at the moment, all in the budget 3-star sector. We have some international development. Some of it's in the Middle East. We have 8 hotels in a joint venture with Emirates. And we have a few in the Far East, some in India, and some in the Philippines and Thailand, but sort of that's a different area. Premier Inn is about growth. In the UK, over the last 4 or 5 years, they've been turning out between 4,000 and 5,000 rooms a year. This last financial year, we actually got to 5,446 rooms opened. That was a mixture of extensions, new builds, leases. So they're about growth. They're looking at which other markets they can grow into. We've done a lot of research and analysis, obviously not myself, but the people before me. And we've looked at Germany and we've looked at Europe generally, and we come out of the UK and we actually see that the macroeconomics and the tourism characteristics of Germany match quite well with the UK. And that's a market where we perform quite well in, and we think we can actually bring our product here and perform quite well in Germany as well. We've looked at some of the other countries in Europe because we had to pick one country. And if you look at France, my old colleagues there are very successful, and there are some other big colleagues there, so there's a lot of competition and it's quite a tough market. Economically, Germany is much stronger than France at the moment. And also in the budget sector, we also see that there is a lot of potential, like Gail said. We believe that the chains haven't penetrated as much as in the UK or in France, and therefore we see that there is opportunity and growth potential here in Germany. So we're quite excited.
Thank you, Ian. If I may ask Gael, what are your investment criteria, and is it so? What type of asset do you like to buy? And how difficult is it to find product for you in Germany at the moment? I mean, we've seen the chart with yields going, dramatically down. Is it still an attractive and good market for you? And can you tell us a bit about, maybe you use examples with your recent investments in Germany, because it's quite substantial what you did.
Okay. Roughly in 2015, we have invested in Germany around 300 million euros. And it has been split in, we have done a sale and leaseback with Motel One. So it was, and we acquired Berlin and Frankfurt, Motel One. And because we want to compete a little bit with my friends from Union, but they are far away with Motel One. But,
you mean with price or?
No, with price we are better. And we have done also some, we acquired a lot of B&B portfolio from Carlyle, 22 B&B last year also from Carlyle, and on a fixed triple net approach. And we also acquired a portfolio of Motel One that we converted into management contracts with Louvre Hotel to do premier class. So we consider such a way we have the B&B, Motel One, premier class So we have quite a good exposure to the budget segment in Germany. And so we see that in terms of strategy, how to find new deals, this is with the partnerships that we have. For example, with BNB as well, we are industrializing a process of new developments. So we built a dozen of BNB last year together. So we source the deal, they source the deal, we do it together. After the change that we see that you have a lot of competition for a specific asset, if it's a good location, a good lease contract, blah, blah, blah. And when we see your yields, let's be clear, at 4% cap, I cannot buy, or I prefer to bypass and wait for a decade, and that's it. So that's why we consider, for us, new development or structuring through management contract hybrid structure. It helps to have a higher yield and to be more in line with our objectives. And we don't need necessarily to be in top city center of the prime location of major cities. So this is where we can accept also to be in secondary cities since the business model works well. And what is very important for us is the sustainability of the rent, to see that our tenant will earn money forever. So which is to say, if he is happy, will he be happy? So it's a long-term play. So that's the key element that we are looking at. Of course, once we are clear on the location and the product, this is the second point we are looking at it. If we have that, and we hope that we have a better yield than your 4% cap or 4.5% that you mentioned.
For core markets. Yeah.
Yes.
Yeah. And you mentioned Premier Class and Motel One. Are they also partnerships you want to develop? So we'll see more Premier Class with your capital, or what is this? What will we see from you in the future?
What is important for us is that we don't do. We have a partnership approach with our hotel operators, which is to say, we don't do a deal just for a dozen of hotels or for few hotels. And today we have one Motel One or two Motel One in Germany, but we signed a Motel One in Paris, for example, a few months ago. And we want to go each business line with each partners. And because we consider when you have a significant portfolio with your operating partner, this is where you can have you can have a favorable negotiation in one point, but you give concession to in other part of the portfolio. It's more win-win approach, and you have more way to do arbitration or to do global negotiation with your partner. And with Accor and BNB, we have a good size, but with the others, we can still grow with Accor and BNB, but the others, we need to have much more.
And what if you want to say, what is your cash-on-cash yield requirement for what do you look at? What attracts you?
As high as possible.
Okay.
And it depends on the risk-return profile that we are taking on a management contract. We are looking for a premium, but we are between 8 to 10% cash-on-cash. We use a reasonable leverage, and so that's roughly what we are providing to our shareholders.
Okay.
And,
okay, Andreas, can you tell us? Sorry, do you want to say something?
No. It's okay.
I think your strategy is quite different to Gaël's, where you're more focused on core markets,
he's
single
rich,
assets. He's the rich guy here. If you can tell us maybe a few examples of what you acquired last year and how easy or difficult it is for you to find product that meets your investment criteria.
Yeah, well, I wouldn't say that I'm rich. It's because it's more that I think we did a very good job in the last years, and we got a lot of trust and confidence, and therefore many of our investors would like to go via union investment, and that's actually the reason why we, again, in future are very thoroughly looking at what we are buying and what assets are on the list. Yeah, of course there are challenges also on the German hotel investment markets which we have to face. It's of course one side much higher competition than in the past. The prices are going up, and of course here and there management agreements are on the move, but not everywhere, and I think we can find good ways to find the right deals for us. There are various ways what we are doing. We, for instance, are not just going into silly bidding processes where like 15 parties bidding for one asset, and then the one who is paying the highest price is getting the asset. That's not the way what we are doing. We really would like to be more sophisticated here. We like to structure deals and also be active in the acquisition from the very first moment, also being in active conversations with developers, with operators, and sometimes are even the driving factor in putting a deal together. We already have managed and shown that in the past, for instance, with the Holiday Inn in Mainzer Straße in Frankfurt. So therefore, active structuring is of importance. We like off-market deals, so like to do that also with strategic partners, which we have trust in. Sometimes there are still developers out there in the industry who would like to get one LOI and one price and then go over the market and shop around. That's actually something which we don't like, so therefore we are happy to work together with companies who you can really trust in. We are also going into secondary locations, so of course the market is hotting up in primary locations, also therefore we do regard and see secondary markets as quite attractive, as brands are not well represented even in an even higher form in the secondary markets in Germany, in one or the other, and therefore I think that's another good move. And then coming back to the structure management agreement, we can't do, therefore we can do direct lease agreements. We are happy to do triangular structures where behind the lease agreement there is, for instance, a franchise agreement. We did many deals with Holiday Inn Expresses or with Hampton by Hilton, for instance, or also a management agreement, what we did, for instance, in a sale and lease back with UBM in the same mentioned property in Frankfurt, where the developer is keeping the role as an asset manager under a management agreement as granting a lease to us. So I think there are ways of structuring deals and still getting along even in a more challenging environment. I think there are good opportunities out there still.
How do you make it work in this relatively sought after markets with yields going down and factors rising?
Yeah.
Do you see a change over the last 12 months in terms of expectations from the developers or the vendors, or how do you see that?
Expectation in
terms of pricing or yield compression?
Yes, of course, yields have been coming down, and then we, in a certain way, are also prepared to follow that trend, of course, to a certain extent. We get into the deal at a very early stage, as mentioned, and therefore like to save the deal at a very early point of time with the developer, are in active conversation with them in order to really save the hotel on the forward purchase agreement basis. We've got a very sophisticated technical department, experienced guys here within Union Investment, and this helps us a lot in structuring the right deals, not only from the contract point of view, but also from the structural and technical point of view.
How early can you sign a deal? If let's say it's now 2016, let's say the hotel opens in spring 2018. Is that something you would look at, and do you feel that you have to come in earlier and earlier to get the deal?
Yeah, that's a very good question, Olivia, because in the past we said we want to have the building permit already on the table, otherwise we would not touch it. But this has changed during the last.
Then you lose it.
Yeah, exactly. So therefore we are getting approached even in bidding processes of the developers for the plot.
Oh,
so that may be too early sometimes, but maybe
So you wouldn't negotiate with anybody who's not even the owner of the plot, would you?
No, we wouldn't. But we're getting approached.
Okay.
We're getting approached.
Thinking of buying the site.
We'd like to have certainty that the deal will be secured and safely secured by the developer, and then we'll be happy to come in at an early stage. Would prefer with a max of 2 years before opening. but could be slightly high longer as
What
well.
yield premium do you get for taking that extra risk and for waiting for so long, in terms of if you compare that to existing products, same quality?
I think the premium is not that high any longer, to be honest, but on the other side, it really helps us to really get our hands on really very good locations, and that's everybody's envious about our Frankfurt Holiday Inn deal, Mainzer Landstraße. You know, is how did you do that? You know, to get a hotel right in the center. Also for the Merlier La Défense, where we put together the deal actually ourselves and brought the operator to the table when we talked to Vinci. And also the same thing, you know, and everybody's asking them, how did you do that? Yeah, well, we were early in the game and put all the pieces together, and that's a play which we really like.
Mm-hmm.
Yeah.
Understood. So it's more securing the real estate
Yeah,
rather than
exactly.
getting more yield. And Ian, you're entering the market in quite a hot market, as we just discussed, with very low yields and very tough pricing. Especially in Munich, you saw the data, the prime yield 3.6%, and in Munich you bought an existing office building in the city center. How do you make it work from Whitbread's perspective to enter a market at this point in the cycle?
All I'd say is, have you tried buying property in London at the moment? It's,
I haven't, but I hear about it.
Germany's still a market where there's value in the land prices and in the real estate prices. So we work on a similar model to the hotel model we've got in the UK, and we can get the returns we require buying such properties in AAA locations like the Sonnenstraße. And if we look at the property that we bought 6 months ago, and we look at the prices today of similar properties that are up on the market at the moment, in similar locations, the prices have actually gone up since then. So it's not standing still at the moment. It's quite difficult. The really good properties are sought after a lot. A lot of developers are going for these sorts of properties because of the yields at the moment. We feel we do have a bit of an advantage because we can move very quickly. We were able to do the deal on the Sonnenstraße coming in 2 weeks before we actually did the deal. We turned it over very quickly. And we're using our own financing, we're using our own capital. Whitbread are quite happy to have the real estate. From our property in the UK, from the 730 hotels, 63% are freehold properties from Whitbread. The rest are lease contracts, as it were. So they are quite happy at the moment, and the strategy is to roll out the hotel program on a freehold basis, doing the development ourselves.
So that's your preference, but if you can't buy the asset, then you would sign a lease, or you would let it go and first acquire more hotels?
Our preferred option is to do a freehold. The Frankfurt hotel, we allowed the GBI to build the hotel for us, and we took it over on a turnkey basis. So that's possible for us. If there is a very, very good location within Germany, we would enter a lease agreement. But our preference is to take the freehold. Mm-hmm, mm-hmm. But I know there are a lot of investors in Germany that don't want to give up the real estate and want to hold it and take a normal standard German double net lease, and we understand this, and we're not averse to leases, as we've got quite a lot in the UK.
And you are financially...
Triple net.
Yeah, we've got triple net in the UK, that's true. But I mean, triple net, double net, it's a question of price at the end of the day. Yeah, so... I mean, we're used to both, but I mean, we'd be happy to do a normal double net lease in Germany.
I'm sure you'll be highly sought after by the likes of Union Investment, a strong balance sheet from Whitbread. So can you tell us, do you have, I don't know what you can say, but what is in the pipeline? What are you looking at the moment?
Well, we're only looking at the top 6 cities in Germany at the moment, and 4 not so big cities at the moment. We've opened Frankfurt, we've got the Munich hotel, the Munich building we've secured another site in another city, and we're doing a few deals at the moment, but we've got a pipeline of 2 at the moment. as
It's
Jandl
100%
would say.
the portfolio.
Yeah. So we've got one hotel and two. No, we've got one
No,
hotel
it's
and two deals
200%.
done. Yeah. So yeah, we think we should get about 6 or 8 deals done this year. We're only looking to have 8 to 12 hotels open by 2020. So we'll probably be opening in 2018 4 to 6 hotels, and in 2019 the same amount. So we should hit the targets. But we are looking for AAA sites, which is difficult in the market at the moment. There's a lot of competition, and we're prepared to wait to make the right deals and get the first hotels correct. And once we've got them up and running, and we've got our operating model sorted and the hotel product we're allowed to develop a bit further, then we'll be looking to grow a bit quicker.
So if you were willing to sign more leases, you could do it much more quickly, right? But you rather go step by step.
We'd rather go step by step. We'd rather take the freehold. I think even if we could get leases now more quickly, but it doesn't mean you'll get the product at the end of the day quicker. Leases take invariably longer, the actual development process. So actually being able to do the freeholds ourselves and the development ourselves should be able to mean that we can develop quicker in the beginning.
Okay. And Mr. Jandl, can you tell us about your brand strategy? We just heard that Residor is buying Prize Hotel, a relatively small, trendy budget operator. I think only 2 or 3 hotels open. But is that also a business model that you would look at to add to your existing product? Or how do you position yourself going forward with all the people wanting to buy budget or developing budget product?
Well, if we talk about Germany being a hot market, of course, for us it's a different angle, which we look at this market as we operate 60% of our portfolios, 70% of our portfolio within the German market. So therefore, it's a very hot market for us. We are sure that we have a good knowledge on this market, and we are very well set up with Steigenberger and the Intercity brand. I would not say that we are not looking at the market in terms of other possibilities, but we see very good chances for our existing brands, especially with the third brand coming up now with the Jazz brand. Steigenberger brand is always located at the best locations within cities or airports. Intercity hotels is always at train stations, and this is a must. And the Jazz, we see 3-4 cities in Germany where we could have a Jazz hotel, which might be Berlin, which might be Hamburg, which might be Munich, probably Cologne, Frankfurt, but then it's done. So within our brands, we have still very good opportunities to grow. Of course, we are always planning and having our strategies where to go, but nothing is set. And as we did it with the Jazz brand, when we launched the Jazz brand, we only made it public once we had the hotel, and it was 3 months before the opening. So this is the way how we work, and you can be sure we think about different opportunities, but we never talk about them before the egg isn't boiled. We would not talk about it. But knowing the market, we see a lot of opportunities. For example, Intercity, we say wherever is a station, a train station and a hotel in 200-300 meters walking distance, and this city has more than 150,000 overnights, it's perfect for us. And we clustered, I say, the bigger cities in Germany with Intercity. Now we're going into the secondary cities as well. We see very, very good opportunities there. And on other sides, of course, Hamburg, we have 3 existing Intercity hotels, and we are thinking about more locations in Hamburg. In Munich, we are looking for more locations. In Frankfurt, we are looking for other options as well. So it's not only on second and third tier cities as well. In the main cities, we see good opportunities. And with having this clear profile on all our brands, I think we are very successful whenever we open. I don't know who attended the party last night in our new hotel at the Kanzleramt, the Steigenberger. It's open now since 1.5 years, and the performance is outstanding good. Intercity Hotel next to it with another 400 rooms opened 2.5 years ago. So we brought another 800 rooms to the Berlin market, and we're very happy about it with our brands. So this might, long way to your question, we feel very comfortable with the brands we have. We know we can operate them excellent on the market. They all are very profitable. Owners are happy, investors are happy, and we are happy with the results. So there's not a need to fool around with other, playgrounds.
You have quite an efficient brand with the Intercity brand, which is a limited F&B operation as well. So
Intercity is a very, very interesting brand, and for any investor, and with very high margins, with very, very interesting rents we are willing to pay in terms of relation to the investment. It's a very clear structure, it's a very clear design, it's very easy to calculate. We can tell you now what it will cost you until the last cent if you do the right contract with the construction companies, but we know very well how much it costs. And so this is, I think I see at least another 30 Intercity hotels in this market within the next 5-6 years.
Mm-hmm. And a subtitle of this session is also the future of leases. I used to think when I was younger that also here we'll see more management contracts, but it just has not happened, and I don't see it really changing much. But now there's a talk about the IFRS rules being implemented also here in Germany, where the tenant has to put the liability of the lease for all future years as a liability on the balance sheet, which according to our normal standards is not the case. And how do you as Steigenberger deal with this situation coming up? Are you changing your business model, or what is happening in your company? Is this a topic at all?
Of course this is a topic. We are Germans and we think about everything we are doing. Sorry, but no, but this is the German way compared to other countries.
I didn't expect anything
doing the same,
Yeah.
No, but for us, please, I do not want to sound arrogant, but it's a matter of fact. For us, it's no problem at all. We are a private-owned company. We are not listed on the stock market. We have no bank liabilities. Therefore, the impact would be that we stretch the balance sheet on the active, but on the passive as well. So this has an influence on the Eigenkapital, the equity. But the equity is only interesting for banks and for the stock market. If everything goes smooth, if everything goes well, and if you produce positive results, and this is what we do, this has no impact. So I think we even see an advantage for us, as we do not have these handicaps, bank liabilities or stock market. Mm-hmm. I think for our friends from investment side, I really call them friends as they are friends, as we cooperate very well in many fields with hotels. They finance and we are able to operate. I think for them this will have an increase. There is less operators which will be able to do that. And we have the advantage as well that we sign all our lease contracts with Steigenberger AG. So we do not need any vehicles, we do not need any lease companies in between. So it's really direct. The investor knows he has the operator and the brand within one hand. And this is a clear advantage. And for us, of course, we do not like it to stretch our balance sheet. But if it is the case, so what? We can very well live with that.
Mm-hmm. And Andreas, is it a topic that affects you as Union Investment that you talk about with your colleagues, or?
I haven't seen that at all. So I've told earlier about various models we are looking at. Not all of our tenants are listed at the stock market. We have, of course, also medium-sized company which may work on a franchise basis, which may be affected less. Then at the end of the day, the exposure somehow, the guarantee which is backing the lease contract may be somehow limited in certain ways, so there should not be a commitment for until the end of the day. There is limited commitments to be somehow set into place, which may also be helpful. And then at the end of the day, I think if an operator wants to get into a location, he still signs a lease. In this very hotel you're sitting here is a lease agreement on with IHG. They don't want to tell that. They don't like to tell that, but that's what it is. Even the big ones are doing, even the ones from the UK and the US, they are signing leases if they want to go in strategic locations. You should know that, and that has never changed, and it won't change.
So no worries from your side. And Gael, can you talk to us a little bit about how you leverage your investments, if at all, and what percentage, and how you structure your deals from that front?
Today, at the FDM level, we have quite a reasonable leverage at 31%.
It's reasonable, yeah.
Reasonable, yeah, perhaps too low, but and in average, we are using 50-55% leverage maximum. We use leverage in any case, but sometimes we do the development first, and after we finance to save time. So we are quite flexible, and we have sometimes a corporate debt that we use at the FDM level, but main part of the time we have a hedge on the asset, and that's the traditional way we are structuring the debt.
Do you work with the German mortgage lending banks, or do you have your French partners, or how do you?
Both. Both. We're open to work with anyone, but we have a strong partnership with French banks. But I have to say, German banks are quite interesting on lease contracts. On management contracts, it's maybe more difficult, but we can work with both type of banks, and it's okay.
So you also see margins from the banks coming down and the competition increasing to finance your product, or?
We see we can finance today between 100 bips margin to 150, and depending if this is a management contract or not, can go to 190 or 200 max, but main part of the time it's 120, 140 bips, so which is okay. But we still have a yield premium between office and hotel, and that's a pity. One day perhaps. But we see still a lot of appetite to finance in our projects, also the development. But I would say since we stay at a reasonable leverage, we don't feel any risk at all. The challenge will be more if we use 80-90% leverage. And we see that we have rumors from the UK that it's starting to be more and more challenging to have a highly leveraged position. So this is where
you're quite conservative.
Yeah.
And Andreas, what is your view? We saw the chart before where we have yield difference for the prime office yield and the hotel yields, where we have, let's say, roughly 100 basis points, or whichever market you look at, but let's say roughly. Do you think that gap is here to stay, or do you see that shrinking? And do you think it's fair that hotels get a premium, or what is your view on that internally at Union Investment? You must talk about that quite a lot in terms of return for your hotels and your other office and retail investments.
Yeah. I think indeed in the past the gap has been higher and has been shrinking already to that level. I'm not so sure how far it'll go. It may be going on with the shrinking to a certain level, but think about the availability of office real estate, of prime office real estate, which is nearly inexistent. So therefore I would say, as there are still ways in doing good deals in the hotel sector, that there will be also in the near and middle future the gap between the two asset classes. If that's fair or not, it's more a philosophic question. You may think.
Might be loved hotels.
Yeah, well, for us, we like it, of course, but I think it's simply contributed to the fact that there is still room to grow. We've mentioned various reasons. Gail talked about the low coverage of branded hotels still in Germany, and still room for growth, and all the other reasons which we have been mentioning. There are, of course, now many players in the market would like to jump on the train, not only on the investor side, but also on the developer side. So there are there are many players who would try to ride this trend, and I think it's good that we stay on this track for quite a while in the future.
Okay, thank you. I'm conscious about the time. We have a few minutes for questions. If there are any from the audience, we're quite happy to take them. Yes, please. If you can introduce yourself quickly.
Stand up.
Well, we have a microphone. Hold on. Yeah, wait for the mic.
Thank you. Laurent Bonnefou, Chief Development Officer of B&B Hotel. Just a question for Andreas. He mentioned the fact that he was investing in Poland. Just wanted to know if he invested in zloty or if he invested in euro.
If we also would invest into Poland, we already own 4 hotels in Poland, so we do invest into Poland, and we do regard Poland as a very good investment target for hotel real estate. Actually, not unlikely like Germany, a very decentralized country and very strong domestic market. With like 5 or 6 big cities. The economy has been quite robust during the last crisis, so which tells you that it's a good market, and we do like the market.
And you invest in euro or in zloty?
What is the currency thing?
Euro purchase price, euro rents.
Do you mind if the operation is, the revenue is generated in zloty, obviously? Do you mind that the operator takes that currency risk, or how do you view that?
Yeah, it is. I think it's only partly a currency risk. As you can imagine, many of the guests are coming from euro countries, and therefore only in part the payment will be made in the local currency, which somehow gives you a certain security also to the operator. But from our point of view, we would like to stay at the euro approach.
Yes, please. A microphone, please. Doesn't matter.
Just curious if any of the enthusiasm around investing in Germany has led to maybe overzealous supply growth in any specific markets. Is there any market that you're worried about there being too much supply having been added in the last 2 or 3 years?
Galia, you want to answer that?
But the oversupply?
Your question is whether there's been too much added supply in some of the cities in Germany, right?
Exactly. A market-specific comment. I know broadly Germany is probably okay.
Okay, go ahead.
I don't know. I didn't get. Is this an investor or an operator question?
Both would probably have a perspective.
I'm most happy to take.
Well, I think at the moment Germany is one of the strongest markets we have worldwide, and. What we could see in the last years that the supply was very well absorbed by the market. Of course, we have different markets like Berlin, where we have a huge growth in the hotel business over the last 10, 15, 20 years. The market could easily absorb the additional beds, but the impact was that the rates stayed as where they are the last 15 years. So this is an example of that. There are other markets like Cologne, like Munich, and Frankfurt is a very strong market, which could, really grow with the market, with the supply. With our company, we had a yield growth last year of 6.5%, and we are in this market, and so this means for us it's okay. But it's a question how you position your brand and how you set up the property.
Okay, Punit.
Yeah, my question is for Andreas. Having leases outside of Germany, let's say an Eastern European market like Poland you mentioned, in euros you buy, you want the rent in euros. Mm-hmm. Would you agree to having the cap on rent in the local currency? Because no matter which country you take, it loses 10% on an average in the last 3 years in value. So your rent has a hidden value of increase in there. So would you be willing to at least accept a cap because otherwise you've shifted all the risk of property, of trading, including of employees on the business transfer on the poor operator.
Well, I wouldn't say that this is an issue for us because we think in euros, and the investment would be done in euros, and the cap would be that there would not be a cap which may be attached to the or pegged with the local currency. I think that was the question.
Because your loan or the debt, if you raise locally, of course, union investment is different. You might buy 100% equity, but for any other investor, they would be raising the debt in the local currency. So it's an opportunity for the industry to find a formula that works both for the operator and the owner. I'm not criticizing this thing, but there is a huge opportunity, especially if you were to raise debt.
Yeah. Well, we as that, we are looking at it as a euro investment, and we more analyze the volatility of the currency and see, if the zloty goes up and down, what effect that may have. And I think in all scenarios, we have been in positive territory in means of that there is sufficient coverage on the lease. It may well be, of course, that because of currency fluctuations, that the coverage may go down slightly, but it's still in a corridor which would be acceptable for us, and also at the end of the day for the operator.
Could you think of a formula of a derivative or something, because it's only for 2 years. You can't do it for longer. Somehow to protect the poor operator who is...
The poor operator.
There is no operator in this room who is 1/100th of the balance sheet of Union Investment.
I'm
Maybe
happy.
you have a separate conversation, the two of you.
I think we have a separate conversation on that topic.
Any other questions about the German market? Mr. Wieland?
In both directions. So it's two ways.
Yeah, exactly.
But to admit this question about currency hedge with weak currency countries, especially as for example like Turkey, we have this issue as well in the shopping center industry. And some serious people from ECE, for example, they admit in the medium run we will have local currency revenues, and some sort of gaps we have to look around.
Yeah.
That will be in the end. But perhaps meanwhile Poland will enter the European monetary system.
Keep on thinking. Okay, thank you everybody. I think we have some, if you want to fill in, was there a questionnaire or something that people should fill in? No, that was for the questions, right? Okay, no questionnaire to it. I thought there was a rating or something. No, don't worry. Thank you everybody.
Thank you so much.
Thanks.